Okay, in this video, I am going to show you how to retire a bond. Um, and there's two scenarios when we are retiring a bond. The first one is fairly straightforward. At the date of maturity, we're just going to pay the face value, the amount that we were obligated to pay. And so again, remember, bonds payable is a liability and it's on the books at 100,000. And therefore, if I want to satisfy that bond payable, I'm going to do it with a debit, right? So I'll debit my liability, bonds payable, and then I'm going to use cash. I am going to credit cash. And I don't really have to worry about a discount or a premium, right? If I issued it at a premium or if I issued it at a discount, at the time of maturity, that's going to be reduced down to zero, right? So I remember if I issued it at a premium at maturity, right? This is maturity. I am I have amortized the entire amount of the premium. And likewise, if I issued it at a discount at maturity, I have amortized the entire discount. And so the only thing that I really have to worry about is the bond payable, right? This account. Okay. Now, the alternative is if we were to sell the bond, right, somewhere sort of in the middle of the life of the bond. Okay. And so this next slide is kind of walking us through that. And before we start talking about what's going on in the slide, the way that I would think about removing a bond or retiring a bond, we're basically doing we're doing three things. Okay. We're going to take the old bond or the bond, old bond, off books, right? I have to remove the bond from the books, okay? Then I need to remove cash from the books, right? So if I'm paying somebody, right, I am removing that liability and I am using cash. And then the third thing is I will recognize either a gain on the disposal or a loss on the disposal. Okay. So let's look at what's happening in this particular example. In this particular example, we are going to assume that a $100,000 callable bond, and by callable means the person who purchased the bond has the right to ask for their money back whenever they like. Okay. We're going to retire it on July 1st after the first interest payment. The bond carrying value is 104,500. The bonds have a call premium of 3,000. Okay, so let's first think about what's happening. What is on the books? Okay, the original bond, right? The original bond has a face value of 100,000. And so at the time of issuance, we put that 100,000 on the books. And then in addition to that, not sure what the overall premium was, but it does have a premium, right? Because they're saying the total carrying value of the bond that we're getting rid of is 104,500. Okay. So it must be the case that this value is 4,500. Remember the combination of the bond plus the premium or the bond minus the discount is the total carrying value of the bond. Okay. So the first thing I would do when I said I would take the old bond off the books, I have to debit bonds and then I have to also debit bonds payable. So I'm definitely debiting and debiting. That was step one. And then step two, I'm going to take cash off the books. And in this particular example, they're telling us the bond carrying value is 104,500. However, the bonds have a call premium of 3,000, meaning at the time that we got rid of it, the value of the bond, the price that somebody would be willing to pay for the bond is $3,000 over the face value. And therefore, the total cash that somebody is paying is 103,000. And that's step two, right? And then finally, we need to figure out whether or not we this transaction resulted in a gain or a loss. And think about it. I have a liability of 104,500, and in order to get rid of that, I only had to pay 103, right? And so automatically, I just got rid of a liability, $1,500 worth of liabilities, and I didn't even have to pay anything for that. They just went away. And therefore, that's like a gain to me, right? I just made money. I owed 104,500, and they said, "Hey, just pay me now and you only owe me 103 and we'll call it good." Right? So that's a gain. I paid less than what I had to. And therefore, a gain is like an increase in wealth, and if I want to increase my wealth, that's increasing equity. And if I wanted to increase equity, I would do it with a credit. And therefore, I would credit gain on the bond retirement. Okay, step three. And that is retiring bonds.